If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Israel's second quarter of 2025 delivered something remarkable. Stability that's boosting market confidence across the board. 0.9% quarterly growth, 2.7% unemployment, 4.5% interest rates holding steady. But here's what the numbers don't immediately reveal: geopolitical pressures that should have crushed economic performance. Rising military expenditures pushing debt higher, yet technology exports continue delivering exceptional results. In the second quarter of 2025, Israel's economy displayed marked stability, underpinned by steady GDP growth, low unemployment, and controlled inflation dynamics. The GDP annual growth rate remained moderate and stable. Israel's GDP grew by approximately 0.9% quarter over quarter, maintaining modest but consistent expansion seen through early 2025. On a year-on-year basis, growth aligned closely with projections, reflecting resilient non-oil activity, high-tech exports, and domestic consumption. Unemployment continued to trend downward, reinforcing labor market stability. In June 2025, the unemployment rate declined to around 2.7%, falling from 3.1% in May. The number of unemployed individuals dropped to approximately 125,300, down from 142,700 the prior month. The Bank of Israel's benchmark interest rate held firm at 4.5% for the 12th consecutive policy meeting in July 2025. The central bank maintained this stance in alignment with inflation trends and market expectations, emphasizing steady, cautious policy management. Inflation showed encouraging signs of moderation. In April 2025, annual inflation had peaked at 3.6%, owing largely to rising airfares, utilities, and tax adjustments. By May, however, inflation eased to 3.1%, hitting an 11-month low. This decline was driven by lower transport costs and a stronger shekel, signaling that core price pressures may be subsiding. Debt-to-GDP ratio remains elevated but under control. Following increased military spending in 2024, the debt ratio surged to approximately 69% of GDP. Projections indicate that continued conflict may raise it further, to around 71% by year-end if hostilities persist. Nonetheless, current debt levels remain moderate compared with advanced economy peers. Key macroeconomic indicators for Q2 2025 paint a comprehensive picture. GDP growth approximately 0.9% quarter-on-quarter, annual growth holding steady, unemployment approximately 2.7% in June, improved labor market metrics, interest rate constant at 4.5%, inflation eased from 3.6% in April to 3.1% in May, debt to GDP near 69%, possible rise to 71% with ongoing conflict. These figures collectively reflect a resilient, stable economy managing shocks with adaptive policy responses and solid fundamentals. Technology and export sectors continued delivering strong performance amid global demand for high-tech products. This sector alone has maintained double-digit growth despite regional instability. Innovation hubs in Tel Aviv and Haifa continue attracting international investment and partnerships. Consumer spending remains steady, supported by employment stability and inflation easing. Domestic consumption patterns show remarkable resilience in the face of external pressures. Service sector activity has maintained pre-conflict levels in most metropolitan areas. Consumer confidence indices reflect cautious optimism about economic prospects. Monetary policy stayed on hold, balancing support for the economy with inflation containment. External resilience in current account and bond markets remain stable with solid external financing position, aided by steady exports and remittance inflows that continue supporting the balance of payments. International credit markets continue viewing Israeli sovereign debt as investment grade despite regional tensions. However, key pressures and concerns cannot be ignored in this analysis. Geopolitical conflict threatens economic momentum as continued war efforts and mobilization of reserve forces reduce labor supply. This mobilization directly impacts productivity across multiple economic sectors. Military expenditure has risen sharply, contributing to fiscal strain and pushing debt higher than pre-conflict projections. Inflation hotspots in utilities and transportation remain, requiring continued vigilance from policymakers. Energy costs and transportation fees continue showing upward pressure despite overall moderation. Rating agency scrutiny and possible fiscal downgrades may pressure borrowing costs and investor sentiment. International rating agencies are closely monitoring debt trajectory and fiscal sustainability metrics. Policy recommendations to maintain stability require careful calibration across multiple dimensions. Calibrate monetary policy by monitoring inflation trends closely, as potential rate cuts could follow sustained disinflation. The central bank maintains flexibility to adjust policy stance as economic conditions evolve. Strengthen fiscal planning by implementing temporary revenue measures or reallocating spending to sustain services while managing debt. Strategic budget reallocation can maintain essential services without compromising long-term fiscal sustainability. Fiscal discipline combined with strategic investment remains the cornerstone of economic stability. Support labor and productivity by facilitating workforce re-entry for reservists, encouraging remote work, and upskilling to address labor shortages. Comprehensive workforce development programs can mitigate the economic impact of military service requirements. Flexible work arrangements help maintain productivity while accommodating security-related workforce disruptions. Invest in high-value sectors by prioritizing tech innovation, cybersecurity, and digital infrastructure to sustain long-term growth. Strategic investment in emerging technologies positions the economy for post-conflict growth acceleration. Digital infrastructure development creates multiplier effects across all economic sectors. Diversify exports by expanding trade networks beyond traditional markets to buffer against regional volatility. Geographic diversification of export markets reduces dependence on any single region or trading partner. New trade agreements and market access initiatives provide economic resilience against geopolitical shocks. If these policies are executed thoughtfully, Israel could sustain growth near 3 to 4% through 2025 to 2026, maintain unemployment under 3%, see inflation return to the 2 to 3% target range, and stabilize debt to GDP around 70% with disciplined fiscal management. The resilience demonstrated is a testament to strong institutional frameworks, diversified economic activity, and prudent macroeconomic management. Democratic institutions and rule of law provide the foundation for economic confidence and international investment. Institutional quality rankings continue supporting Israel's position as a stable investment destination. Continued adaptability and strategic investment will be critical to sustaining stability and fostering recovery. Should geopolitical conditions improve, pre-positioned investments will enable rapid economic acceleration. Long-term planning horizons must balance immediate security needs with sustainable economic development. In conclusion, despite significant external risks, the Israeli economy in Q2 2025 remains fundamentally stable. Anchored by steady GDP growth, low unemployment, easing inflation, unchanged interest rates, and manageable debt. This stability reflects strong institutional frameworks, diversified economic activity, and prudent macroeconomic management. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.